Welcome to the deep dive. This is where you, our listener, send us the source material. It could be reports, articles, anything really. And we dive in and unpack the key insights for you.
Yeah, and for this deep dive, we've got a really timely piece. It's the latest fiscal assessment report, just out, June 2025, from the Irish Fiscal Advisory Council. Gives a proper look at Ireland's economy and finances right now.
Okay, so our mission today is to really get under the hood of this report. What's it tell us about Ireland's economic strength at the moment? What are the risks, both external and internal? And crucially, how are the public finances looking and how's the policy managing it all? The report title itself kind of flags it's strong now, but maybe an uncertain future.
That contrast is spot on. That's the core message up front, really. The report says, yes, Ireland's economy is strong, but, and it's a big but, it's leaning very heavily on corporation tax from just a handful of big multinationals.
Right.
And it also flags that government spending is climbing much faster than planned. Overruns look likely. Plus, those external risks like trade tensions, they're ticking up.
Yeah.
And the report argues the current setup, the way public money's managed, isn't really built for that kind of volatility.
Mm-hmm.
And then you've got the big future challenges looming: aging, climate change, infrastructure. They all need serious planning, like now.
Okay, let's get into it then. What does the report actually say about where Ireland stands today? I have to say, I was struck by how positive the report is about the starting point. It uses words like resilient, strong position heading into 2025. What's backing that up?
Well, it points to a few key things. First off, the jobs market. It's incredibly strong. There's a figure showing something like 85% of people aged 25 to 54 are working. That's a record share.
Wow, 85%.
Yeah. And the report notes things like, more remote working, maybe even the pressure from high prices might be pushing participation up.
And are wages keeping up? It feels like that's been a concern for a while.
It seems they are catching up, yeah.
Yeah.
The report shows real wages, so pay after inflation are basically back to where they were heading before the pandemic hit.
Okay, but there's an interesting split. For lower paid sectors, real wages are actually above the pre-pandemic trend now.
Oh, right.
Whereas for the high-paid sectors, real wages have been pretty flat for 5 years. So they're actually below where that trend would have put them, even with lots of jobs there.
Interesting divergence. And what about debt, households and businesses?
That's another positive point the report makes. Both families and Irish companies have kept borrowing relatively low.
Right.
So that low debt picture on the domestic side adds to that feeling of resilience.
Right.
Although it does add a little footnote. Maybe low investment by those domestic firms could eventually hurt productivity down the line.
Okay, so that's the solid ground. But then the report shifts, doesn't it? It talks about storm clouds gathering. What's the main external worry?
It's definitely rising trade tensions around the world. Tariffs, friction between the big players, especially the EU and the US.
And how does that actually bite here in Ireland? Just the uncertainty? Well, yeah, the uncertainty alone is disruptive. It messes with investment plans, changes trade flows. And for Ireland, because we're so reliant on sectors like pharma and tech.
Yeah, the report really highlights that unusual concentration, doesn't it?
It does, an unusually large share of jobs. So these trade tensions, they raise really fundamental questions about future investment here. Will those big companies keep expanding in Ireland?
Right.
I mean, pharma products, they aren't hit by U.S. tariffs right now, but, that could change. And building a new plant takes, 5-10 years? So companies need that long-term certainty.
Sure.
And it's not just goods. Services could get hit too if things escalate. Imagine a tax on digital ads that would hit the tech HQs in Dublin directly.
Okay, now here's a bit that really jumped out at me. Just as the report is outlining this threat, particularly to pharma, it shows this massive surge in pharma exports to the U.S. early 2025.
Ah, yeah, that figure.
I mean, $40 billion in just Q1. That's almost the entire value for all of 2024. What's going on there?
It's a staggering number, definitely. The report kind of suggests this might not be sustainable growth. It could actually be companies shipping product now.
To get ahead of potential tariffs.
Exactly. Proactive stockpiling, maybe.
Yeah.
If that's the case, it implies we could see exports fall off later this year or next. It's not necessarily a sign of underlying strength continuing at that pace.
Right, makes sense. And the report tries to put some numbers on the potential economic hit from all this trade friction.
It does. It pulls together some studies, yeah. They estimate Ireland's real GNI, that's the measure that strips out some multinational distortions, gives a clearer picture.
Got it.
That could be maybe 2.2 to 2.4 percentage points lower over, say, the next 7 to 10 years. Depends how bad things get, obviously.
That's quite a range.
It is. And
Yeah.
the report itself adds the caveat, these economic models often struggle to fully capture the real impact of just pure uncertainty, that chilling effect.
Okay, let's switch focus then to the public finances. The report says, on the surface, things look pretty solid. But dig down, and it all hinges on one thing: corporation tax.
That's absolutely the core story here. Ireland's running budget surpluses, yes, but the report is blunt. This is almost entirely down to what it calls phenomenal levels of excess corporation tax.
Excess, meaning more than you'd expect.
Exactly, more than you'd expect given the size of the domestic economy. It shows the stark chart. With the excess tax, you get surpluses, take it away, and bang, you've got a significant deficit.
Wow.
The report estimates that underlying structural deficit, the gap between ongoing spending and sustainable revenue, adjusted for the economy cycle, is around 2.4% of GNI.
And what does that mean in real money?
Well, it works out at over €2,500 for every single worker in the country. That's the underlying hole if that excess tax wasn't there.
Okay. And it's not just volatile, it's also coming from very few places. Right?
Highly concentrated, yeah.
Well,
3/4 of all corporation tax receipts from U.S. companies. And it gets even tighter. Most of that excess bit we just talked about comes from just 3 companies.
3 companies? That is risky.
It's a huge concentration risk, absolutely.
Okay, so massive risk, huge reliance on a few players. But then here's another twist I saw. The report actually suggests corporation tax might come in higher than the government's own forecasts in the near term. How does that work?
Yeah, that's a really interesting counterpoint they make. They give 4 main reasons why they think receipts could surprise on the upside.
Okay.
First, they think the official forecast for the impact of those big international tax changes, the OECD, BEPS, Pillar Stingy stuff, is way too pessimistic. The government penciled in a negative $2 billion hit in 2026, but the report reckons just Pillar II alone could bring in an extra $3 billion. That's a massive swing, like a $5 billion difference in expectations for 2026. And they don't see Pillar happening quickly anyway. Second reason is, well, the biggest taxpayers themselves, tech, pharma, they're actually telling the revenue commissioners they expect their global profits to rise. So higher global profits could mean higher tax payments here.
Okay, makes sense.
Third, there's this thing called capital allowances, basically tax breaks for investing in things like patents. The report suggests these might be running out for some big multinationals. If so, their taxable profits could go up.
Oh, okay.
And fourth, remember that massive pharma export surge in Q1?
Yeah?
Well, that could give revenues a bit of a temporary boost this year, even if, as we said, it might not last. Okay, now switching to the other side of the ledger, spending. Here, the report seems much more certain. It basically says spending will be higher than planned in 2025.
Yeah, and I noticed it points to a specific, kind of surprising reason why they're so confident about that overrun.
It does. It highlights that the pretty large spending overruns from last year, 2024, they came in $3.2 billion over budget.
Okay.
Well, those overruns were basically just ignored when they set the spending plans for this year, for 2025.
They just didn't roll them into the baseline.
Seems that way. So the starting point for this year's forecast was already too low, and the evidence is already piling up.
How so?
While current spending is just growing much faster than the budget assumed, the first 5 months of 2025, spending was up 5.9% year on year. The budget was built on growth of just 1.4%.
It's a big gap.
It is. So based on that trend, the report says, look, another big overrun, probably around $2 billion, looks likely again this year.
Well,
And it stresses this isn't just health, it's happening across most government departments. And there's a specific point on public sector pay, too. The pay bill jumped 8.6% in the first quarter of 2025. More rises are already baked in. Yet the official forecast for the whole year is only for 3.5% growth in employee compensation. Again, there's a disconnect between the forecast and what's actually happening. Points to overruns.
okay, so spending is likely higher. What about the underlying tax base? Everything except that volatile corporation tax. The report seemed a bit worried there, too.
Yeah, that's right. While the headline revenue number is boosted by CT, the report notes that these underlying revenues have actually fallen as a share of national income, of GNI.
So the base is shrinking, relatively speaking.
Kind of, yeah. It's narrowing. Taxes on production and imports, think excise duties on petrol, diesel, alcohol, tobacco, and also VAT. They're down as a share of GNI.
Why is that?
Partly shifts in behavior. less fuel use maybe, but also a shift in spending from goods, which tend to have higher VAT, towards services, which often have less or none. Social contributions, PRSI, are also down relative to GNI because of how the base is calculated. And even income tax is getting narrower. The report projects that a third, 33% of all income earners won't pay any income tax or USC this year.
A third? Wow, that's up from 30% just back in 2019.
Exactly. So you put all that together, and the report shows something pretty stark. If you strip out that excess corporation tax, the underlying government revenue, compared to the size of the economy, is at its lowest point since 1980.
Since 1980. But on a slightly brighter note, the debt picture isn't too alarming, even without the excess CT.
That's true. The report does say the debt dynamics look okay. The debt to GNI ratio is projected to fall, and the actual cost of servicing that debt, the interest payments, are at a record low because interest rates were so low for so long. So that's a positive.
Right. Okay, let's talk about how all this is being managed then. The policy stance, as the report calls it, and the whole fiscal framework.
Yeah, the report is quite critical on this front. It basically argues, look, the economy is strong, it's running close to full tilt. Standard economics says budgetary policy should be leaning against that, cooling things down a bit.
Showing restraint.
Exactly. But instead, the report finds policy is actually providing quite a bit of stimulus. That underlying structural deficit we talked about, 2.4% of GNI, that's pumping money into an already strong economy.
Right.
The report calculates the pace of tax cuts and spending increases is actually double what it thinks is sustainable in the long run. And you've got this fiscal stimulus happening. At the same time, the European Central Bank is starting to lower interest rates, which adds monetary stimulus too. The report calls them twin supports.
Pushing the economy when it doesn't really need pushing.
Precisely. And warns this could just lead to higher domestic inflation, higher rents. Not ideal when the economy's already near capacity.
The report also mentions the government's plan. If there's a downturn, they say they'd keep spending going, but maybe hold off on tax cuts.
Yes, and the report calls that approach pro-cyclical, which is basically the opposite of what textbooks recommend. Well, standard advice is stimulate when the economy is weak, restrain when it's strong. This plan suggests stimulating when strong, but then providing less support by postponing tax cuts precisely when the economy turns down and might need help. It could actually make a recession worse.
Not ideal. And looking at the bigger picture, the rules and framework for managing the public finances.
Yeah.
The report sounds pretty damning. It says there's no effective framework or credible constraint.
That's a very strong line, yeah. And it backs it up with several points. First, the EU fiscal rules. They're based on GDP.
Which we know is inflated for Ireland.
Massively. By multinational stuff. So looking at debt relative to GDP gives a false sense of security. The EU rules also don't really get to grips with the riskiness of that excess corporation tax. So Ireland might look fine on the EU's GDP metrics, but the report flags that underlying structural deficit using GNI is around 2%, which is probably too high for a strong economy. Second, the domestic framework is weak. There's no proper domestic spending rule. The old one was just symbolic, got broken all the time, wasn't even properly set in law. The report flat out says there is no domestic net spending rule in place.
Okay, no rule. What else?
The planning horizon is too short. The government's main annual report only looks ahead 20 months.
Just 20 months.
Yeah. The report calls that a major backward step from the previous 5-year plans. You just can't plan properly for big long-term challenges like aging or climate if you're only looking that far ahead. And finally, even the medium-term plans that are supposed to exist aren't being followed. The law requires setting spending ceilings for departments for future years, 2026, 2027. The report says they just weren't set, calls it a clear violation of the law.
Okay, so framework issues. Now, let's look properly at those big future challenges the report flags, the ones Ireland faces no matter what happens with trade wars or corporation tax, aging, climate, infrastructure.
Right. Aging is described as the biggest medium-term budget challenge, and the demographic shift is stark. Today, about 1 in 6.5 people is over 65. By 2057, it'll be almost 1 in 3.
Wow, merely a third.
Yeah. And that means huge pressure on budgets, more healthcare spending, long-term care, pensions. At the same time, slower growth in the number of workers paying taxes. The report also notes the decision not to raise the pension age adds to that pressure. And it really stresses the cost of waiting. Acting now or soon on aging is estimated to be about 40% cheaper than delaying action past 2035.
Sooner is much cheaper.
Much cheaper. The government has started saving some of the excess CT in the Future Ireland Fund, and there are plans to raise PRSI contributions, which the report welcomes. But it says these steps will still not fully offset costs. The fund helps, but it won't cover everything. Okay, then climate change, the second big one. The actual spending needed for the transition renewables, retrofitting homes, that kind of thing, the report thinks is manageable. Around 0.6% of GNI a year, maybe $2 billion today.
Okay, so the spending side is doable.
Yeah, but the bigger issue on climate is the loss of revenue. As we shift away from fossil fuels, the government loses all that tax revenue from petrol, diesel, motor tax, etc., and related spending like VAT on those things.
How much are we talking?
The report estimates the potential loss, if the tax system doesn't change, could be around 1.6% of GNI or $5 billion in today's money.
$5 billion? That's huge.
It is. It's nearly as much as the USC brings in each year, so that revenue hole needs plug-in somehow. And then there's the cost of not acting. If Ireland misses its climate targets, which it's currently on track to do by quite a margin, the cost could be enormous, up to $26 billion, the report estimates. That's the potential cost of having to buy emissions credits or statistical transfers from other countries, paying others because we didn't meet our targets. The report calls it a colossal waste.
Colossal waste, yeah, you can see why. Okay, finally, infrastructure.
Yeah, the third big challenge. The report shows Ireland lagging quite significantly behind similar European countries, about 25% behind on average across key areas like housing, health, transport, electricity networks. Catching up needs sustained high investment for years.
And why are we lagging?
Well, part of it is a hangover from the financial crisis.
Wow.
The construction sector basically collapsed. Capacity was lost. Workers left. The report also points to low productivity in construction here, about a third lower than peers, partly due to less use of modern building methods. And then there's the planning system slow, prone to objections, causing delays.
So what needs to happen?
Sustained state investment is key. Plus, efforts to boost construction productivity embracing those modern methods. Streamlining planning, the new Planning Act, might help, but the report says it's too early to say, and making it easier for private finance to come in too.
Okay, so let's try and pull this all together. We've covered a lot of ground from this report. What's the core message for you, the listener, right now?
I think the central point the report keeps coming back to is that Ireland is in this really quite uniquely strong position today. You know, the economy's resilient, the public finances look good on the surface thanks to CT, and that strength gives an opportunity.
An opportunity to prepare.
Exactly. To prepare for those definite challenges coming down the track, the aging costs, the climate transition, the infrastructure gap, and also to build buffers against those risks, the trade tensions, the corporation tax volatility.
And the report has specific ideas on how to do that better, particularly on the fiscal framework side.
It does. It has a kind of checklist for a better framework, and depressingly, it finds only 1 out of 8 key things is actually in place right now, which is having savings funds like the Future Ireland Fund.
Only 1 out of 8. Ouch. What are the key missing pieces?
Well, fundamentally, budgetary policy needs to smooth the cycle, restrain when things are strong, support when weak, which, as we saw, is the opposite of the current stance.
Right.
We need clear, incredible, sustainable limits on government spending growth each year, a proper spending rule. The focus has to stay on competitiveness and building that infrastructure, no matter what the short-term global picture looks like. And maybe crucially, spending forecasts need to be realistic. They need to start from a baseline that actually includes likely overruns, not just wishful thinking based on ignoring last year's overspend.
Okay, so translating that, what does this all mean for you listening? It means, I guess, understanding that while the headlines might look great jobs are up, there's a budget surplus, the stability underneath is maybe narrower than it looks.
I think that's fair. It depends heavily on a few specific, concentrated, and largely external factors like those big CT payers and global trade conditions, things largely outside Ireland's direct control.
And it also means seeing that those future costs from aging, from climate, they aren't abstract, they're real, they're quantifiable, and according to this report, we're not really putting aside enough or planning properly for them right now.
Yeah, and if you link that back to the other issues, the report raises the constant spending overruns, the weak framework. They make it harder to actually do the sensible long-term planning. Even with all this money washing around from corporation tax right now, the system isn't geared up to use this period of strength to prepare for the leaner times or the inevitable future costs.
The report basically says now is the time to fix the roof while the sun is shining, so to speak.
Exactly. That's the core argument. This moment of strength is the window of opportunity to put things on a much sounder footing for the long term.
Right. Well, that brings us to the end of this deep dive into the June 2025 Fiscal Assessment Report. Thank you for sending in the source material. We hope this unpacking of it was useful for you.
Yeah, reflecting on it, the thing that really stands out is that stark contrast, isn't it? You've got this immense current strength, but it's driven by these very specific, potentially fragile factors. That sits right alongside these huge, predictable challenges that the report argues just aren't being adequately addressed by the current policy approach or framework.
And maybe that leaves us with a final thought to mull over, something directly from the report's underlying message. It lays out the risks and the challenges for Ireland very, very clearly. But it also highlights this unprecedented opportunity the country has right now because of that strong starting position to actually tackle those challenges head on and shore up its future. Yet, the report simultaneously shows how little is actually being done today to plan for those definite future costs and known risks.
Mm.
Which kind of raises a pretty important question, doesn't it?
Mm-hmm.
Could Ireland, right now, in its moment of peak strength, actually be letting that current prosperity mask some deep underlying vulnerabilities? And in doing so, risk missing this crucial window to make the changes needed to secure its long-term economic future. Is the planning adequate for what's coming?
Something to think about.
Indeed. Something to consider. We'll be back soon to dive deep into another set of your sources. Thanks for joining us on The Deep Dive.